Next, we have the lies that blockchain fans tell themselves and anyone else who will listen. Jason Bloomberg, Forbes contributor, best-selling author, top 5 digital transformation influencer in 2018. Please welcome Jason.
Thank you. Hi, thank you. And thanks for sticking around. Here it is after 6 o'clock, but there is a party tonight, so the real hardcore partiers are here, so that's good. So let's see if we can get this to work. There we are. So a little about me. I'm president of Intellix, industry analyst firm focused on agile digital transformation, which essentially means all of the disruptive trends facing large companies, of which blockchain is one of many. I'm a contributor to Forbes. I'll be writing a Forbes article on this conference, and we published the Agile Digital Transformation Roadmap poster, and I'll have the URL for downloading that at the end of my talk. So one of the challenges here with blockchain, and this is especially true at conferences like this, is what I like to call the blockchain echo chamber. That is, you get the community of people in blockchain, and they end up talking to each other, they end up building solutions for each other, and they end up essentially listening to each other, and now that creates a whole range of problems, and that's essentially what I'll be talking about this evening. So, lie number one that blockchain fans like to tell themselves is that selling to the echo chamber is viable long term. A lot of the solutions here, maybe they're wallets, maybe they're transaction systems or whatever it is, there's basically vendors are here selling to other people who come to this conference, and you end up with this community of people selling to each other. The challenge is, in order for blockchain to be successful long term, customers have to be outside this community. Right, you have to sell to either it's individuals or sell to businesses that are not part of the blockchain community, not part of the blockchain ecosystem, and that's when money will come in terms of real business. Right, the fact that a lot of the money in this industry is coming from speculators who are betting on various companies, that is misleading this community into thinking that there is real value. But real value comes by providing goods and services to customers who are willing to pay for those goods and services. And that's the piece that's missing. So if you're only serving the community, it's like moving deck chairs on the Titanic. Right? You can keep busy, you can have a lot of activity, there's a whole community built around this stuff, but it's not going to be viable long term unless you sign up customers outside the community. Okay, line number two. Your blockchain business will pass its tipping point. So now this, you may be the exception. You may have a company that will pass its tipping point, but I talk to a lot of companies here as well as around the world who are building blockchain-based companies, and this is the number one challenge that most blockchain companies have. And again, it's not 100%, but I would say, in my experience, well over 95%. So the tipping point is the tipping point for the network effect. Right? If you have some sort of service whose value depends upon the number of people who are obtaining the service, then the challenge is that before you reach this tipping point, there is insufficient demand to drive producers of the service, and if there aren't enough producers of the service, there will be insufficient consumers of the service. Right? So somehow, if you have this kind of business where you have providers of a service and consumers of a service, and your business is predicated on having enough of both of those, you need to have a way of getting to the point that you have enough. And before that point, your business model is not viable. That is, you don't have a way of getting enough customers because you don't have a way of getting enough people to provide a service, and vice versa. So you need some sort of way of getting past this tipping point. So when companies pitch us all the time, trying to get us to write about them, and if they pitch us a business that has this problem, I'll ask them, how do you get past the tipping point? And a lot of times the answer is, well, we're going to issue tokens. And so we're going to issue tokens, and then we're going to have tokens, we'll give out tokens, and enough people will be interested in the tokens that will sign up all these people, both providers and consumers of whatever service you're dealing with, and that's going to be how you pass your tipping point. Well, that's not the answer, because the tokens have no value unless there is sufficient demand for the tokens. And before the tipping point, you do not have sufficient demand for your tokens. So if you think issuing tokens is a way to get past your tipping point, then that is a lie that you are telling yourself. All right, lie number three. Permissioned and permissionless blockchain really have anything in common. This is an enormously confusing point, especially when you get outside our little echo chamber here and you start talking to the broader world. Everybody's heard of blockchain. All these companies want blockchain. Blockchain is this hot topic, but few people understand that permissioned and permissionless blockchain are very different things, have very different value propositions, have very different challenges. So really, it would be best if we just called them very different things, right? We use blockchain for one of these and come up with a different word for the other one because they're so different. So permissioned is really the type that I cover because we cover enterprise solutions. So solutions for big companies are permissioned and hence centralized. There's some sort of central authority that is approving the transaction processors, the miners. And if you have a central authority that is approving the miners, then you have a permission system, and now businesses can at least potentially trust that the system is free from criminals and is going to appropriately handle the transaction processing. That's the sort of blockchain system that enterprises are looking for. So if you're familiar with Hyperledger, the open source blockchain infrastructure, that is a permissioned infrastructure, driven in large part by IBM for IBM customers, and those are the sorts of companies that are interested in permissioned blockchain. Now, a lot of the people here are really here because of their permissionless or decentralized blockchain. So decentralization is a hot topic, and when you get into the blockchain echo chamber, a lot of the discussion is about decentralization. Well, as I mentioned in my panel yesterday morning, one of the challenges with permissionless is that essentially anybody can be a miner, which means that criminals are welcome to be miners. Not all miners are criminals, but miners are welcome to be criminals because it's permissionless. Nobody needs to get permission. And as a result, big companies who care about who's processing their transactions are going to steer clear. So this permissionless world is going to be a world of potential business models that don't serve the sorts of companies who care that some of the miners are criminals. So you have to decide for your company, what are you going to do? Are you going to be part of the permission centralized world and give up on all this decentralization goodness, but build real solutions for real companies? Or are you going to be part of the permissionless world, allow for the fact that criminals might be miners, and realize that your customers are only going to be customers who don't care that criminals could be miners? And you'll just have to make up that decision. But remember, the press largely lumps these together. So there's still a lot of confusion on this point, which can mislead people into thinking that they're doing one when they're really doing the other. All right, line number 4. Allotting tokens to founders is ethical. So this is a very common situation, and I've talked to many founders who essentially they want to issue an ICO, they create all these tokens, and of course the founders get some of the tokens. That's sort of the point to issuing tokens. The founders get some of the tokens, the investors get some of the tokens at a discount, and then other tokens are maybe reserved for some of the employees, sort of like a reward system, and then some tokens are part of the economy. That is, you're going to release them into the wild, hoping that the consumers of your product are going to value the tokens. But the problem with founders owning tokens is that it essentially incents them to pump up the value of the token. So people like to think of tokens as though they were like shares of a startup, shares of stock. But they're not. They're not ownership shares, right? So a token does not give you a part of the company. So in a traditional business, the founders will have stock, right? And now they are now motivated to turn their business, which starts at nothing, into a company that has real value, in which case the stock will be worth something and they can sell their stock and retire to Jamaica. And that's fine. But tokens are different because the tokens do not represent any value other than the value that the community of the token economy puts on those tokens. So there's an inherent conflict of interest. If you're a founder and you have tokens, then you'll want to sell the tokens. If you sell them too fast, the tokens will drop in value. So anybody in that community of people who have the tokens, people who want the tokens, always have to look at the founders and well as the investors and say, when are they going to dump their tokens? Why would I buy a token, assign it any value, if a founder or an investor could flood the market with their tokens at any point in time and sink the value of my tokens, right? And if that's a problem, then you're never going to get to the situation where you have enough customers who value your tokens in order to build a token economy, which is one of the keys to passing that tipping point. All right, line number 5. Line number 5, there we are. Market cap is meaningful. So market cap stands for market capitalization, and it is a term out of the familiar world of finance, and in the context of equities, that is a company that issues shares, a public company. Market capitalization is the number of outstanding shares times the value per share. So you multiply those two numbers, and you end up with a number that represents the value of the company. So far, so good? Okay. Now, what does it mean for market cap to represent the value of the company? Right? Apple Computer, I call it Apple Computer, it shows how old I am. Apple Incorporated just passed the $1 trillion market cap. What does that mean? Well, if Apple Computer said, I'm doing it again. If Apple said, well, we just don't want to be in business anymore, we're going to sell off our assets. What would they do? Well, they could sell off parts of their company to other companies. So they could sell off, the iPhone to Samsung, and they sell off business divisions and get a bunch of money, right? They could sell off their physical assets, all their buildings and all of their equipment, and get a bunch of money. And of course, they have a lot of money in the bank as well. Add all that up, and that is essentially the breakup value. Now, that breakup value for a company would be less than that $1 trillion. So what's the difference? Well, the difference is the value of future profits. That is, if you buy a share of Apple, you're saying, well, is it worth X dollars? Well, part of it is the breakup value, and part of it is a bet that the company is going to continue to do well. Maybe they'll issue dividends, and potentially, of course, you may be able to sell your stock for more because somebody else is also betting that that share has real value in terms of the equity of the company, in terms of its breakup value and the value of future profits. Okay, so that's what market cap really means, or originally means. Now, in the blockchain world, we use the phrase market cap to mean something similar, but really quite different. The number of tokens times the speculative value of each token. So the number of Bitcoins in the world times the current market value of a Bitcoin is the market cap for Bitcoin. And you can do it with any kind of token that has a current market value. Number of tokens times the current market value of a token, you end up with this figure called a market cap. But it is not the same as a market cap for an equity because there is no breakup value, right? If let's say that you have, I don't know what it is, the Bitcoin market cap is, let's say, $100 billion. I don't know what it is. And now let's say, okay, all the miners shut down, right? All the miners shut down, everybody goes home, but we take what's left and divvy it up among all the people who have Bitcoin. What's left to divvy up? Miners shut down, all the Bitcoin is turned off, and now you divvy up what's left. The buildings? What buildings? The business divisions? The iPhone division? No, there is nothing left, right? There is nothing there. All there is the speculative value. That is, people own cryptocurrency because they expect somebody else will pay them more than they paid for it. Right? Even if you're a hodler and you're not expecting to sell it, there is still a potential sale in your future. Maybe who knows how many years it is down the road, or maybe you'll give it to your grandchildren, or then they'll sell it, who knows. But the reason you own it is because somebody else is a greater fool. Right? Bigger fool than you, and is willing to spend more than you paid for it, and that's what you're hoping. That's a speculative value. So what's the market cap of a cryptocurrency or any token with a market value? It's a measure of the speculative interest. It's a measure of whether the people who own the token think that there are greater fools that are willing to pay more for it. But there is no underlying value. And this is important because you start talking about market caps and what's the market cap of all cryptos in the world, and it's some massive number. And people say, wow, it's this massive number. That's important. No, it's not. It doesn't represent anything of value. Right? There's nothing of value there. All it represents is speculative interest. It's just a measure of how crazy everybody who owns this stuff is. Right? The crazier you are, the bigger the number. If people finally realize that it's just smoke and mirrors, the number will go down. That's all it's a measure of, is the craziness of the people who own these tokens. All right. Well, nobody's thrown anything, but I do see some smiles, so I think I'm on the right track. Okay. Lie number 6. Now, this is one that does have exceptions, but it's generally a lie. Customers will want your tokens. So the whole token economy, and I've talked to a number of companies here, both yesterday and today, try to ask them about their business models, and maybe it sounds good, and maybe there's some real value they're providing, and maybe they even have a way past their tipping point. And everybody who gets past that tipping point question stumbles on the token economy question. The problem here is there's no demand for your tokens. Nobody wants the damn things, except, of course, the people who are betting on being able to sell tokens for more than they buy them for, the speculative interest. But aside from speculative interest, there is no underlying value, or at least insufficient underlying value to build an economy. So this is the challenge, right? A lot of business models are based upon tokens, and there's all these reasons to sell tokens, sell them to investors. The founders have them. They'll eventually sell them so that they can retire. And then we have providers and consumers of your service, and the providers can can sell tokens, and the consumers are supposed to say, well, I want your service, and so I'm going to value the tokens it needs to get the service. But the problem is, usually, they would just rather pay cash for your service. Why would a consumer of some sort of token-based service want to pay tokens? Why would they value tokens? Especially since tokens represent essentially the risk that the founder and the investors want to shift to the consumers of the product or service, right? If you're a consumer of a service and you hold tokens that represent something you can get from that service, you're taking all the risk, right? Because if that founder decides to dump all their tokens, then whatever you got, you want your tokens to buy the next vegan sandwich or whatever it is you want to do, and now all of a sudden an investor or the founder dumps their tokens, you can't buy your vegan sandwich. You're screwed, right? So this is the problem, right? The market, either short-term or long-term, will be dominated by people who want to sell their tokens, and there'll be insufficient people who want to buy the tokens. So if anybody here remembers Economics 101, Adam Smith's invisible hand, you have an asset that a lot of people want to sell, nobody wants to buy, price goes down. And if nobody wants to buy it, the price goes down to 0. Okay, well, that's it for my talk, aside from the conclusion side. So in conclusion, the reason I'm here, I'm not here at this conference to bash silly blockchain business models, although it's sort of an interesting hobby of mine. That's not really why I'm here. I'm here to write an article, but what I'm really here for is to find those gems in the rough. Companies with business models that involve providing goods and services to customers who will actually pay for them in a way that generates revenues and profits over time. In other words, real businesses. This is the difference between a business and a hobby, is that you have customers who are willing to pay you for something at a price they can afford, and they need to pay you with something of value, in other words, money, or something that represents money, right? And those business models are rare and limited. Now, there are some out there. I didn't run into any here at BlockShow, but I have run into a few, but they are quite rare. So, second key lesson: the echo chamber, the community of people who are emotionally as well as financially invested in blockchain or crypto, fools people into thinking there's real value where there is not. And this can be risky for any of you who are betting on this whole community, whatever it is you're doing, to make you rich or to pay the bills or whatever your core motivation is, right? There may simply be no real value. It may be speculative interest alone that is keeping everything alive. There's all this money going into ICOs, everybody's going crazy. Wow, look at all this money, and of course there's a few people who've made a lot of money, and everybody else looks at them and says, well, they made a lot of money, why can't I? And that just generates more speculative interest. So, and of course, there's the crime element. I didn't want to spend too much time on that this evening because I talked about it yesterday, but speculators, scammers, organized crime dominate this whole space. There may not be that many bona fide criminals here, although I did have one person come up to me and said, but I'm a criminal. And it's like, well, there you go. So there's at least one person here who's perfectly happy to admit to it. But this is really dominating the whole world. It's sort of like the poorly kept secret of the world of blockchain and cryptocurrency is that it's just primarily about criminal enterprise. So if you're not a scammer, how many people here aren't criminals? Okay, it's not a trick question. I'm hoping everybody raises their hand. Of course, you see that it is a trick question. If you're not a scammer, then you're probably a mark, right? A mark being the target of the scam, right? So it's one or the other. Either you're the scammer or you're the mark, because so much of this is nothing but smoke and mirrors. Again, there are exceptions. I'm looking for those rare exceptions that are real business models where you're really providing value to customers who are willing to pay for that value. If that's not what's going on, then scammer, mark, take your pick. All right, so that's it for my talk, but I see I have about 4 minutes for Q&A. There's my Twitter handle, email address, and if you want to get a copy of the poster, agiledigitaltransformation.com. Okay, so for the, supposed to do the block thing. Okay, so over here, needless to say, I wasn't in baseball.
How you doing? Jason.
Yes.
Richard Kafali. It was a breath of fresh air listening to you talk today.
Very good.
What I do for a living is basically I travel all over the world and I find the bullshit artists, the pump and dumps, and I try to make my investors shit tons of money off of that. So
you're in the right place.
So it was great hearing your talk because you're on the money on that. Basically, I guess mine's more of a statement. I mean, I feel bad for anyone that paid for this conference, but it's this, guys. My conclusion wrapping up here on this show, everyone wants to learn how to make money here, and there's two guarantees the way to go. One, you're investing in mining equipment, the people that make the tools, all right? During the San Francisco gold rush, the people that mined the gold didn't make any money. The people that gave them the tools to mine the gold did. So that's your first area. And if you want to tip on some of that, I'll give you an email at the end of this. The second is the salvage company who's going to salvage all that mining equipment that these people bought and then liquidate them and then buy them at a low cost and sell them back. That's the second one. Salvage and mining equipment. You invest in those two companies, you're going to make money. That's my conclusion wrap up of all this blockchain nonsense. So if you want the tip on the mining equipment to do, it's going to be a simple and elegant mining equipment. You can email Agani, A-G-A-N-I 2323 at gmail.com, and I will give you that tip. But that's it. Thank you so much, Jason. You're right on the money on this.
Sure enough. Any other questions or comments? There's one over here. If you just toss it directly over to this fellow here. Oh, good one. You were in baseball.
So my question is, what's the answer to your question? Like, what have you found? Like, what business models have you found?
The area that I see some real possibility are any sort of complex multi-party transactions. So complex multi-party transactions, especially where transparency has always been a problem. So these are supply chain transactions, logistics transactions, and there are some opportunities with real estate as well. So real estate transactions, right? Because they may have multiple parties that are involved in transaction, and they may not all trust each other, and they all need to have a single view of the truth in terms of the state of the transaction. So there are some interesting things. Of course, IBM on the enterprise side is working on one big proof of concept with Walmart and food safety. Has a lot of potential. And they're also working with Maersk on international logistics. So those are two great examples. One of the problems is, those are the only two examples that ever come up. You know, it's like you keep going to these enterprise blockchain shows, and it's like, oh, there's Walmart, food safety, and there's Maersk, and then there's Walmart, and there's Maersk, and it's like that's the whole list. So it'd be great to have some more. And real estate, I know there's some real estate people here. Real estate is a potential, but it's not about the tokens. It's about the transactions and about visibility. It's really about having an immutable distributed ledger. Good question. Other questions?
I got a question. For
Okay,
you,
this is
Mr.
going to be the
Bloomberg.
last one. I have 23 seconds.
Okay, all right. I'll try to make it quick, but I do want to say that yesterday you really hammered on the criminality aspect of it, and I felt like today, hearing what you have to say is a lot more definitely like I agree with a lot of what you're saying.
Okay, very good.
Very rational. My question though is that how do you see a difference between the criminality involved in blockchain and Bitcoin versus the criminality that existed 20 years ago before this? You know what I mean? Like there's been criminals forever. What do you see stopping criminality just by stopping through regulation by Bitcoin?
Well, obviously, it's difficult to stop criminals. If we knew how to stop criminals, we wouldn't have any more criminals. In the technology area, right, cybersecurity is a huge business, and the hackers always seem to have the edge, right? So any big business needs to lock all their doors, eliminate all vulnerabilities, where a hacker only has to find one. So there's an ongoing progression, ongoing cat and mouse game as businesses improve their security, improve their technology, cybersecurity technology, and the hackers then also improve their technology as well. So one of the key things to keep in mind is that the broader historical context for Bitcoin in particular, but really for this whole story, is a progression of increasingly improved tools for criminals. Right, so if you look at, I just did a piece on this earlier this week, bulletin board systems from the 1980s became tools for criminals. Usenet, originally just hobbyists exchanging information, became a tool for criminals. Then BitTorrent, right, share files with your buddies, tool for criminals. What was the problem with BitTorrent? Well, it wasn't sufficiently anonymous, and there was no economic mechanism, no way of making payments. So what do you get when you have BitTorrent? Great way of sharing big files. You can share your pirated movies, your pirated software, your child pornography. How do you fix those two problems? Bitcoin! Hence, Bitcoin plus BitTorrent equals the dark web. And why do we have the dark web? Bitcoin. The dark web would not be what it is today if criminals didn't have a better way of conducting transactions. Bitcoin, not sufficiently anonymous? Monero! Right? Progress keeps going. The criminals are getting better and better at this stuff. And hey, you guys are helping, whether you like it or not. Okay, I'm done. Time's up. Thank you.
Thank you, Jason. Everyone give him a huge round of applause.